Social media interactions become interesting only when it is two-way. You must get a fair chance to interact with the person you follow or the person whose videos you watch. I have started this new initiative, Ask Milestones to Wealth Anything, AMA in short, through which all of you can stay in touch, ask me questions you like to ask, clear your doubts on personal finance, learn more about Milestones to Wealth and about our PMS products, and stay connected. So, this brings us closer. I am able to be closer to you, to help you in whatever way I can. You feel closer by asking whatever you wish to, and we grow together, helping each other along the way. So fill in this form and stay connected through Ask Milestones to Wealth Anything. I'm going to talk to you on the topic, should you stop investing at market highs? Every market cycle will see a high. Investors don't want to get caught in investments at higher valuations. So, more investors are inclined to rethink whether they want to invest at all around market highs. When index is near the high, I see a lot of people saying, I won't invest now, I'll invest later. If you are only investing in the index, this is a fair strategy. But if you are a bottom-up investor who is very stock selective or stock specific, then should your investment decision really be based on where the index is or where your individual company is? Should the index decide for you or should the company's valuation make your decision? To my mind, the individual decision in that company should prevail if the valuations are in favor. We should not delay a decision simply because the broader market is trading at a high. But I don't think investors are really ready to look at that objectively, because many times they would have invested in the broader market or in products that reflect the broader market and lost money. And these losses would have been substantial. And these are very deeply entrenched in the psyche of people. So they don't want to make that mistake as they become more experienced in the market. This is a fair thing. People should not make investment mistakes. But in the name of not making investment mistakes, one should not miss out on making important investments. The line between that is very thin because fear is driving our decision at that point in time, and we fail to be greedy where there is a need to be greedy. So, while on the one hand you feel very uncomfortable about the index when the markets are around a high, that fear should not stop you from being greedy in investments or in opportunities where you are having high conviction. Many stocks that have been bought around the highs of 2018, when the markets, the small cap index, were at the high of 2018, have after 5 years actually doubled. But the index has only hovered around the same high. An investor should ask himself a question, am I investing in stocks which are closely correlated to the index? Am I investing in stocks which are driven by the index or by sentiment, or am I investing in businesses which are driven by valuation, future growth and better prospects? If the answer is inclined to make you believe more in the company than in the broader market, then that decision should not wait. As a professional, my primary goal is to make more and more people see this distinction clearly so that they don't miss out on opportunities when they are ripe and right before them, simply because the highs of the index are scaring them. Because you are fishing in a place which is very different from where the weather is rough. And when you are fishing in a place where the weather is conducive and the waters are calm, you should not avoid fishing. That in essence is what every one of us should remember whenever we are faced with a situation where the index is trading high, but individual investment opportunities that you want to invest in are still favorable. Make the distinction, make the cut, make your moves and make victory yours. Thank you for watching this video.